Okay, so without further ado, please join me to welcome Professor Martin Lockett, Dean of NUBS China, to introduce the speaker today.
Thanks very much indeed. I'm delighted to welcome one of my colleagues to give tonight's talk. The talk is entitled Economics Funfair. So it's a great title, and I can see why we have so many people here tonight because of that. It's how do you study economics happily and critically? So just a little bit of background on Jari. He has a double bachelor's degree in economics and mathematics from Renmin Daxue in China, and it was followed by a PhD from the University of Munich in Germany. So again, like most of our staff, a very international background. He joined now almost 4 years ago, and some of you may know him because he teaches in this lecture theatre quantitative methods 2A, and he also teaches international economics. And his main research interests are about macroeconomics, monetary policy, and China's economic reform. He's also getting internal fame for his weekly WeChat, that's introducing various economic articles and in a critical way. So tonight's talk is about economics and about how do you study it. I'm going to ask you 2 questions, and I want you to put your hands up. How many of you think economics is difficult? Put your hands up. Is economics difficult? Yes. Put your hand up. Okay, so you're going to get some help tonight. How many of you think economics is boring? We have a few people who are honest. That's good, great. Okay, so Jari is going to be is addressing both those who think economics is difficult, but also trying to stimulate more your interest in economics. And so, why is it interesting? When is it interesting? And so on. So, I mean, there are good reasons why some people will think it's boring. You've got textbooks, often very general, and then academic articles. Well, they're academic articles. They don't necessarily tell you so much about what's happening in the real world. And Jari is interested in what's the connection between economics and the real world. And that's what some of the things we're going to focus on tonight. So really, it is a fun fair this evening. I hope it's going to be fun. And what he's going to do is to talk a bit about what do economists, what do they talk about, and what really matters to people in business, government, who are listening to them. So I don't want to say any more. I would really just now like to introduce Jari Zhang to give our talk on Economics Funfair, studying economics happily and critically. So let me hand over to Jari.
Okay, thank you very much, Professor Lockett. Hi, good evening, everyone. I'm very honored to be here tonight and to present a public lecture for you. I know that this stage has a very high profile, and to be honest, I'm quite nervous, because this is also the first time I'm presenting a public lecture, and the thing I'm going to present is nothing significant, The topic I'm presenting today is called the Economics Funfair. This is actually related with what I have been doing recently. Maybe some of you know that I'm currently writing a series of small articles interpreting the academic papers in economics, but in a relatively funny way, right? Like talk shows. This is actually just a little hobby of mine. And it's not a very significant thing. So that's why I feel nervous to share my hobby with you, right? My initial intention of this sharing is when I was doing my own research, I searched a lot of literatures. And normally when we search for literatures, we search the literatures and focus on some special areas. But also we happen to notice that there are some interesting papers that are published on very top journals and investigate some interesting questions. So I want to remember them and hopefully someday later I can learn from them. So I take notes. And then I realized that, okay, why don't I share these articles with my colleagues and with our students? Okay, so in Chinese we have a saying, 独乐乐不如众乐乐, right? It is more joyful to share the joy than enjoy it alone. Yeah. So if I share these articles with you, then maybe our colleagues can discuss the latest research ideas, and maybe our students may fall in love in economics. Yeah. So then 1 week after another, we have this small column economics fun fair. Initial attention is to try to let you know that economics can be interesting. Yeah. And indeed, if you come with me in this column, then maybe you will find that we can learn a lot of critical thinkings from these papers. Okay. So maybe some of you will feel puzzled. Yeah. Economics is difficult, and those papers are not very friendly to read, right? Why should we study economics? You know, why do we learn economics? Okay, I also asked this question several times, yeah, when I was young, yeah. So the answer, probably because we want to get rich, yeah. Because, you know, economics talks something about money, right? So if we learn economics, we should learn how to make money. Okay, I remember when I was studying economics during my undergraduate study, like several years ago, every time when I visit my parents in the hometown, they asked me whether they should buy this stock, or whether my relatives all come to me, whether they should invest in a house, or what are the most profitable investments. And I really don't know how to answer that, right? This is very awkward. It's like you have a friend who studies computer science, and you ask him, can you fix my computer? Yeah? Student who study computer science doesn't know how to fix computer. And student who study economics doesn't know how to become rich, right? If economists know how to become rich, then we are all billionaires now, yeah? And my parents didn't believe me. Yeah? They look at me in a suspicious eyes, okay? It's like they are saying, my tuition fee was wasted, right, in the college. So they asked me, okay, don't you care about economic policies, government policies, contemporaneous economic issues? Yeah? You see, we have a lot of experts nowadays, right, trying to explain us what the government policies are and what effect of these policies might have on the stock market, on the real estate market, and so on. Yeah? So don't you care about this? Can you analyze these kind of questions? And I still don't know how to answer that, right? I mean, I tried very hard to think what I have learned in economics. And all I can remember is some curves shifting from here to there, from there to here, right? So this is maybe what you have learned in economics, okay? This is why somebody call economics the curve shifting economics that we are learning, yeah? So I was unable to answer my parents' question, okay? So maybe because the textbooks are too general and they don't teach us how to analyze the real economic issues, yeah? Maybe there are some simple models to make the predictions, but in most cases, the predictions of our textbooks models are wrong, right? So I decided to learn more, okay? So after I graduated from Renmin University, I decided to pursue a PhD study in economics. Hopefully by then, I will be able to answer my parents' question, how to become rich, right? So I went to Germany, and after 5 years, I came back to China. And I still don't know how to answer my parents' question, yeah? And you know, what is the most ridiculous thing is, I have a lot of undergraduate classmates. After graduation, they choose to work in Beijing. And I went to Germany for a PhD study. So for the 5 years, I was doing the PhD in Germany, trying to figure out how to become rich. And when I came back, my classmates bought a house in Beijing, and they really became rich, right? So studying economics didn't make me rich, okay? So I realized that, okay, we have to sometimes, okay, to answer this kind of questions, okay, probably reading textbook is not enough, okay? Economics does not tell us how to make money. Probably they are telling us how to think logically, critically, or in economic terms, how to think rationally, right? Rational behavior, okay? So if we really want to analyze the real economic issues, probably we should read some academic papers, okay? See what are the latest research findings. Maybe they are investigating some related questions, okay? But we know that those economic papers, academic papers, are very difficult to read, right? They're full of equations, and we don't really understand those papers unless you are expert in that area, okay? For example, if I open an economic journal and randomly select a paper, so this is normally what I see, yeah? A paper like this, yeah? This is a paper from one of the best economic journal, American Economic Review, okay? So it says, the unit price of a mortgage can be expressed as blah, 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 blah. There are so many symbols, right? And I really don't know what these symbols mean. And the funny part is, you see the author says, to ease the notation, they have tried their best to make this easier, right? But still, that's very difficult. Okay. You know, every time when I see a paper like this, I have the feeling that economists are not very self-confident. Why? Because they try to make others believe that economics is science, like physics and chemistry, right? So to explain a simple problem, they apply very complicated models, mathematical equations. Yeah? Also, they use very sophisticated econometric techniques to analyze the data, okay? And we know that in economics, it studies human behavior. And human behavior is highly unpredictable, right? Everyone is not behaving according to this equation, okay? So it's really difficult to describe human behavior with this kind of equations. Of course, I understand why they did this, because indeed, we sometimes need a prototype to analyze economic issues. It's like how Newton analyzed physics in the environment of vacuum, right? So we need some kind of prototype model to analyze. But if they do this, this paper becomes so difficult to read, okay? Many of our students, they are frightened by these equations, okay? When they read these papers, it's too difficult, so they give up. Okay? It's a very big pity, yeah? And also, there are some of our students who became obsessed with these techniques, okay? They are a fan of the mathematics and data, so they develop the model in a more and more complicated way. And to that extreme, they sometimes even forget about economic intuitions, okay? Become the technical party, right? But in academic papers, there are some economists who can combine these techniques with economic intuitions very well, okay? And they indeed investigate some interesting questions, okay? So I think it's worthwhile to share this kind of paper to you, and maybe we can have some fun there, right? This is my initial intention, have some fun while studying economics critically, okay? Of course, economic studies are very broad. Yeah, we have many areas. We have macroeconomics, microeconomics, labor economics, industrial economics, financial economics, political economics. What else? Institutional economics, monetary economics, labor economics, and so on. Yeah. But we have many very good journals as well. Okay, so here are some examples. Okay, these are all the top journals in economics. And among these journals, we have 4 King Kong. Okay, American Economic Review, in short AER, and Quarterly Journal of Economics, QJE, Journal of Political Economy, JPE, and Econometrica. Yeah, so these 4 journals are the top 4, the 4 King Kong in economics. Yeah. So I decided to maybe we can search for some interesting papers from these top journals and share them with you. Okay. So tonight I would like to give you some examples about some interesting papers that I found in these journals. Yeah? The first paper comes from American Economic Review. Yeah? It was just published in 2021. Okay. The name of the paper is called Using Models to Persuade. Okay? So this paper tells us how to increase the probability of success when we persuade others. If you want to persuade somebody to take certain actions as you want, how to increase the probability of success. Okay? So in Chinese, we have a funny word to describe this situation. It's called 忽悠, right? This word 忽悠 became famous in China ever since 3 sketch comedies performed by Zhao Benshan and Fan Wei. So maybe for many of our students, you are too young to remember these sketch comedies. Okay? But I strongly recommend you to watch these comedies. It's very funny. In this comedy, Zhao Benshan tried to 忽悠 Fan Wei, a healthy man, to purchase some unnecessary goods, such as a crutch or a wheelchair. Okay, so he used his skill, he made a very good story, so he proposed his own model and successfully persuaded Fan Wei. Okay? So, although these comedies are very funny, but we know in realities, we also see many situations where we see somebody try to persuade others, right? For example, the real estate agencies are trying to persuade us to buy a house. Yeah? A health product salesman is trying to persuade us, particularly the older people, to purchase some health product. Right? And also, there are some stock experts who are trying to persuade us to purchase some stocks. Yeah? So how to increase the probability of success? Okay, this is what this paper investigates. So if we take a look at their initial paper, then of course it's complicated. Yeah. For example, I just try to explain one thing from their paper. Yeah, it's this model, and of course it's difficult to understand this model directly. But let me try to explain it to you at the moment. Okay. If you don't understand it, it doesn't matter. Okay. I will have another way to explain this model to you later using a human language. Yeah. So the model here says H is the data we observe. M is one possible model we receive. Mu0 is our priori belief. Okay? So this term, probability of H, conditional on M and mu0, says that given our priori belief and a model that we use, what is the probability that we can best explain the data H we observed? Okay? Then on the other side of the equation is, given our priori belief mu0 and an alternative model M prime, the probability we can best explain our data observed H. If the probability on the left-hand side is larger than the probability on the right-hand side, then that means the model M is better explaining the data than M prime, right? So if this condition is satisfied, we will choose to believe model M. Then the person who proposed model M to you will successfully persuade you to take the actions he wants. Okay? So this is how we explain this equation. But if you don't understand it, as I said, let me give you one example to understand it. Now, imagine you are a sales manager, okay? And you want to decide whether you should increase the spending on advertisement to stimulate your company's sales. Okay? And you can't make the decision, so you ask your secretary, can you find some data? Yeah? Give me some evidence. I want to have some understanding about the relationship between the investment in advertisement and the sales. So your secretary randomly selects some firms who are in a similar industry as yours, and maybe the size are also comparable, right? Then this is the data he finds. Then what can we infer from this data? The vertical axis here is the sales, and the horizontal axis is the spending on advertisement. So if we take a look at this data, apparently maybe we have some positive relationship, right? Okay, if we increase advertised spending, we can have larger sales, okay? So this is our observation of the data, and maybe some of our priori belief, which is consistent with our belief, right? I think every economy students who have studied econometrics know how to run an OLS regression of this data, right? Okay, have you learned this OLS regression already? Okay, so if you run an OLS regression, then you will have this straight line there, right? Okay, so your priori belief is that by increasing advertisement spending, the sales will increase. Okay, this is your finding and your priori belief. But with this finding, suppose that this is not enough to make you make the decision of increasing the advertisement investment. Okay, probably you think, okay, if I increase the advertisement spending, my sales will increase, but not very significantly, right? So with this straight line, you can't decide whether you should increase the spending or not. Okay, so now suppose there is a guy who comes from an advertisement firm. He came to you, and he wants you to increase the spending in advertisement. Okay? How will he persuade you? How will he persuade you? First of all, he cannot change the data. This is the fact, right? Second of all, your decision will not be affected by her flattering words, okay? Your decision will be made only based on the interpretation of the data, okay? Your decision you need to make now is whether to increase the advertised spending, okay? You don't need to consider the reputation of this guy or his company, okay? If you decide to increase the advertisement spending, maybe you can choose a different, more famous firm to cooperate, right? Okay, so anyway, the only thing you need to decide is whether you should increase spending in advertisement. So how will this guy persuade you? Now with the same data, he will propose a new model, okay? Probably he will say, hey boss, okay? The increase of the advertisement spending will have an exponential effect on sales, okay? The true relationship between sales and advertisement spending is something like this. Okay? You see? Data are the same. And it seems that this red curve fits the data probably better than your initial priori belief, right? Okay? So this model fits the data better, and it's consistent with your priori belief. So probably you will believe his model, and you will be persuaded. Okay? So this is how we use a model to fool others, right? And the funny thing is, suppose the guy who comes to you is not someone from advertisement firm. Suppose it's someone from your own finance department. His objective is to persuade you to cut sales. He doesn't want you to increase spending anymore, okay? So with this data, how will he persuade you? He will tell you, hey boss, okay? Have you heard of theory that if you increase advertisement too much, your customers will become disgusted, right? So the relationship between the advertisement spending and sales has the shape of inverse U, okay? So he will propose a model like this, okay? Then we can see this model fits data even better, right? There's an inverse U-shape relationship. If you increase advertisement spending too much, this will negatively affect your sales, okay? So he proposed this model because he wants you to reduce the spending on advertisement, yeah? So you see, same data, different models, you will be persuaded to different directions, okay? So this is how we interpret the finding of this paper, okay? And later, this paper summarized, okay, if we want to increase the probability of success when we persuade others, okay, here are some cases where who is more likely to succeed. First, the receiver has limited ability to explain the data, okay? When we don't know how to explain the data, then others have larger room to explain the data for us, right? Because we don't know, so they can propose various models to fool us, yeah? Or second, if the data is highly random, okay? If data is random, very random data, then there could be potentially a lot of different models to explain this data, okay? So who is more likely to success. Or the receiver is open to different models, okay? Or the model can make some predictions. You know, nowadays, if someone can successfully predict the stock price or the stock index, then this guy will become famous immediately, right? So this is related with our psychology, the fatalism. Okay? People prefer models that can make predictions, okay? And last, if who is one-on-one, okay? If you try to persuade someone, don't persuade them with a group, okay? One-on-one persuasion is more likely to success, okay? So when I read these conclusions from the paper, it reminds me that, okay, this is so similar to the situation in our financial market, in our stock market, yeah? Okay, maybe our students are still very young, so they don't have too much experience in the stock market. But we know that in our stock market, we have a lot of experts, right? They are analyzing the stock price data and telling us when we should buy, when we should sell, yeah? This kind of thing. Why they are so popular? Why they are very likely to succeed? First of all, for most of our investors in China, they don't know how to explain the data, okay? In China, the investors in stock market are sometimes we call the noisy trader. They are individual trader. It's not like the United States. The traders are more institutional trader, yeah? So institutional traders then have their model to analyze data. But for most of Chinese investors, they are just, you know, random noisy trader, okay? So they don't know how to explain the data. And stock price is highly random. Financial data is highly random, okay? And our Chinese investors, they are open to different models, right? If you ask your parents, okay, then they will tell you, I would like to hear their story, this story, okay, that story, okay? They are open to different stories, okay? So that's why it's so easy to fool somebody in the stock market, yeah? So, for example, have you seen a chart like this before? How many of you are making investment in a stock market? Can you please raise up your hand? Okay, that's very good. Then you have definitely seen chart like this, right? Okay, so this is stock price, some random stock. And then suppose we are at point A. Question, should we buy this stock or sell this stock? For those who are investing in the stock market and for those who do not prefer the analyzing or using the fundamental value, but using the technical analysis, okay? Maybe they have heard something like this. We have a pressure line and we have a supporting line, right? Whenever the stock price reaches the pressure line, people will sell, so the price will drop. And when the price reaches the supporting line, it's time to build up your, to buy in the stock, and the stock price will appreciate, right? So according to this model, then at point A, we should buy in, right? We should go all in, right, to buy this stock. However, what happened afterwards? If you buy in, you will not become rich, you will become bankrupted. So does that mean that the stock experts are proposing a wrong model? Yeah? No, not yet, okay? They will tell you this time is different, yeah? This time is different. We have a new model. The new model says, you see the stock price at this point breaks through the supporting line. And this is a sign that this stock price will fall significantly, right? So they have a new explanation, okay? Because we are open to different explanations, so probably we will be persuaded again, okay? You know, in stock market, we have many kinds of models, okay? Maybe some of you have heard something called M-shaped head, right? So it's like when the stock price has been increasing for a while, and then on the top, it forms an M shape. Decrease, increase, decrease, and then it's an M, right? Then they will tell you this M head is a very dangerous sign that this stock price will drop significantly. Huh? So this is one model. They have another model called, very funny name, it's called a dragon in the pond. Yeah? 池底巨龙. Yeah? It's like the stock price falls for a while and form a long basin, and then the head is climbing up, and this is a sign for a substantial increase of the price. Yeah? So it's called 池底巨龙. Yeah? So anyway, all kinds of models. I'm not here to judge whether these models are correct or not, okay? My objective here is to tell you why it's easy for those experts to persuade us with their models, yeah? Because the data is highly random and we can't explain it ourselves, okay? You know, for this kind of skills, how to persuade others, it's actually also related with marketing, yeah? Nowadays, if the firm wants to increase sales, we not only need a very high quality goods, we also need very good stories, right? Okay? So indeed, it's important to have this kind of skills to persuade others, right? And with this kind of skills, okay, if we want to persuade others, okay, we know that, personally, I agree with the view that a good persuasion is not that you provide more information to others, okay? It's you provide a good explanation or a good model, a good logic, yeah? So we now are in the 21st century. We don't lack data. We don't lack information, right? If you just take off your cell phone, then all the information comes from everywhere, okay? A good persuasion is not providing them additional information. It's to providing them a good model to explain those information, right? What is the most valuable in 21st century? Models, opinions, right? It's not information anymore, okay? So this is what we have learned, okay? And also, maybe some of you will remember that in economics, okay, economics is full of models, right? Maybe you have learned many models, like monopolistic competition model, or in macroeconomics, aggregate supply, aggregate demand model, right? a lot of different models, Ricardian model, and so on. Yeah? So are economists also using models to fool others? We know that economic data is also very random, highly random, and for everybody who are not experts in that area, it's very difficult to interpret those data, right? So that's also perfect for economists to fool everybody else, right? Indeed, okay, I would say economics is full of models, but at least, I hope, based on our research, economists do find the correct and true models, okay? So even though they are using model to persuade you, at least they are using a right model, okay? But sometimes in the history of economic theory development, many models were turned out to be a wrong model, right? For example, one of the most famous model in economics is called the Phillips curve. How many of you have heard of this Phillips curve? Please raise up your hand. Okay. So if you learn macroeconomics, okay, then this is what you will learn in that subject. Yeah? So Phillips curve is proposed by an economist, Phillips. Okay, he observed that there seems to be a negative relationship or a trade-off between the inflation rate and the unemployment rate. Okay, for example, this is the U.S. data between 1956 to 1969. Okay, so in each year, a red dot represents in that year the unemployment rate and the corresponding inflation rate. Yeah. So it seems that according to this data, we indeed have some negative relationship between unemployment rate and the inflation rate, right? Okay, so this is the data. Then how economists propose a model to explain it? So they tried very hard to figure out how to explain this data, right? And finally, they reached a model called the aggregate supply and aggregate demand model. Okay, so how they explain this negative relationship? They will say, okay, if government increase money supply, then we can expect that the inflation rate in this economy will be higher, right? If government increase money supply, inflation rate will be higher. On the other hand, if government increase money supply, firms will find easier or cheaper to raise external finance, right? They can easier get financed. So they will increase investment and hire more laborers. So unemployment rate will drop, right? So on one hand, we have an increase in inflation rate. On the other hand, we have a decrease in unemployment rate. So this is where we have this negative relationship between the inflation rate and unemployment rate. Brilliant. Yeah, this is really brilliant, right? One of the very good explanations. And this model become so famous. And it is written in our textbooks and continue to fool our undergraduate students. If we take a look at the data updated several years later, this is the data between 56 to 1969. Okay, if we take a look at the data of the US data, the same country, between 1970 to 2004, where is the Phillips curve? Where is it, right? Okay, it seems there's no trade-off at all. Okay, so does that mean the aggregate supply and aggregate demand curve, aggregate supply and aggregate demand model is wrong? Too young, too simple. Yeah? The economists have new explanations. This time it's different, right? Remember, don't forget about this word, okay? There is another economist who is also a Nobel Prize winner called Robert Lucas, okay? He tells us, have you heard something called rational expectation? Rational expectation. He says, people are rational. They will rationally expect what will happen in the future and adopt a strategy based on this rational expectation. Okay, so how will he interpret this data? If government increase money supply, we will have inflation. This is true. However, when the firms decide to employ more labor because they can get external financing at a cheaper cost. Yeah. However, workers, laborers, they will expect that there will be inflation in the future, right? They rationally anticipate this. So when they discuss with the firm, they will require an increase in their wage, right? To keep their real wage unchanged. Because laborers demand higher wage, the firms are reluctant to hire those labor. So the unemployment rate will not drop. We will only have an observed increase in inflation rate and no change of the unemployment rate. That's why we lose the negative relationship. Okay? So this is a new model, right? The rational expectation model. And this model becomes also very famous, and it wins a Nobel Prize several years later. In 1991, I remember, yeah? Okay, so based on all the above discussions, okay, what we can learn from this paper, I learned 2 words. Be critical. Be critical with economic models, okay? Be critical with what you have learned in the textbooks. Economics models work because they have made many assumptions. And for most of the cases, those assumptions are not very realistic. Okay? So if those models fail to explain the data, try to challenge their assumptions. Okay? So this is what we have learned from the first paper I shared. Yeah? And as I continue, I would like to share another paper here. Okay? It investigates another question. It investigates the financial crisis in 2008. Okay, let's see how this paper developed a model to fool us and how we can critically think about their conclusions. Yeah? So this paper was published in Journal of Political Economy, as I said, another 4 King Kong journals, right? In 2020. The name is Housing Boom and Bust, Model Meets Evidence. So some general background. This blue curve here represents the house price relative to the income level in the United States. Okay? So before 2001, we see that this ratio was relatively stable around 3, right? 3.3 or something. Okay, so it was relatively stable. Okay, so it's the house price divided by per capita income level. So this measures the affordability of the house price, right? And we see that all in a sudden, starting in 2001 or 2002, this ratio increases gradually and then significantly until 2007. It reaches the peak and then suddenly fell down, right? And that is where we have the financial crisis and the Great Recession. Okay? How many of you have any experience with this financial crisis in 2008? Any one of you have read any literatures or news about this, what happened? I mean, in 2008, you are about 9 years old or 10 years old, right? So you don't have too much feelings about what happened there, okay? It's very bloody, yeah? So this paper tries to investigate what happened during this period. Why we suddenly have a housing bubble, right? And then what happened, why we suddenly have this financial crisis? What are the factors contributing to this house price fluctuations? Okay, so to analyze their paper, okay, let me briefly introduce what happened during 2001 to 2008 and 2009, okay? Because as I see, many of you don't have too much feelings about this financial crisis, right? So starting in 2001 or 2002, okay, what is happening in US is like the house price was increasing, okay? So when house price was increasing, households are buying the houses. When the household buy the houses, they will borrow a mortgage from the banks, right? Okay. How many of you have experience of mortgage borrowing? Probably not too many. Maybe your parents have the experience, or maybe they don't have this experience when they buy a house. Yeah, they have the full payment for the house. Anyway, if they buy the house, okay, because for the U.S. citizens, they don't save too much, right? So normally they will borrow a mortgage from the bank to pay for their house, okay? When the bank lends the mortgage to the household, they will negotiate some conditions, like you should first pay some down payment, right? Like 20% or 30% of down payment. And then you should have some income certification showing your credibility, whether you are able to repay my mortgage monthly, right? So there are some lending standards there. Okay. And the house is the collateral of mortgage lending, meaning that if the household default, okay, when he refused to pay the mortgages, the bank has the right to collect the house, yeah? The house will become the bank's asset, okay? So house is the collateral. So this is the lending model there. But then, with the housing price increasing, households, more and more households are borrowing from the bank and buying the house. And then we see that the lending standard in the United States relaxed gradually, okay? Initially, they require 20% down payment. Then gradually 10%. And the crazy thing is we need 0 down payment, meaning that you don't need to pay anything. You don't need to pay a coin to borrow from the bank, okay? 0 down payment. And initially, you require others to have some income certification, right? The truth is, what was really happening at that time is, at the crisis time, you don't even need an income certification. Just you need someone to recommend you to the bank. This guy is trustworthy. You can lend the money to this guy, and the bank will lend, okay? And the most crazy thing is, in certain cases, when someone borrows from the bank, they don't need to pay any initial down payment. They don't need any income certification. And the first 6 months repayment is moved off, okay? For the first 6 months, this guy doesn't need to repay any mortgages. So this is like what? 6 months free of housing, right? Okay? Why were the banks so crazy at that time? Yeah? We know that when this financial crisis happened, many people were blaming the banks, right? They don't have this standard, okay? The lending standard was so relaxed, so that's why we have this crisis. But why were banks so crazy? Because the house price is increasing, okay? The banks will believe that if the households default, they will collect the houses, and the value of the house is increasing, so it's not risky at all, right? Okay? So that's why banks are becoming crazier and crazier. And also, the bank have some other measures to hedge against the risk, and that is very famous mortgage-backed securities, okay, MBS. How many of you have heard MBS before? Please raise your hand. Okay, so it's necessary to introduce this MBS a little bit, yeah? What is mortgage-backed securities, MBS? MBS is like, okay, suppose that a bank is lending mortgages to many households, right? Okay, then since this mortgage is the household's liability to the bank, so it's the bank's asset to the household, right? So the banks packed all these mortgages together, different kinds of mortgages together, and then securitize it and sell it as an asset, okay? Why does the bank do this? Just imagine when we pack all these mortgages together, okay, suppose one household, one mortgage is defaulted. Then because this mortgage is packed together with other mortgages. Other mortgages might have very good quality, right? So the risk of default is diversified among other mortgages, right? So this MBS is like a risk diversification financial innovation, okay? So the bank packed all these mortgages together and sell it to other investors. When the bank sell this MBS to others, then there's no risk on the bank anymore. If the household default on the mortgages, that will hurt the value on MBS, and that will hurt the wealth of investors who purchased MBS, right? The bank itself will not be affected, okay? So this is called originate to distribute model, okay? The banks originate the mortgage and packed in the security, MBS, and sell it to some others, some investors from Wall Street. Then the bank bears no risk. So banks can take additional risk. They can lend crazily, okay? Then you can see this chart shows that the MBS issuance surged up in 2001, right? Okay, so this indeed confirms that banks are doing this business. Okay. Now maybe we would like to ask, since we know that MBS could be risky, why would the investors from Wall Street purchase MBS, right? Again, because the house price is increasing. The value of MBS is backed by the mortgages, which are backed by the house price, okay? So Wall Street investors, they were not stupid, yeah? They evaluate this MBS and it's indeed profitable, so they purchase a lot of MBS. And then, all in a sudden, in 2007, a wave of default come, yeah? We see a lot of default in 2006 and 2007. When we have a lot of default, what happens to this MBS? I mean, when the time is good, when everybody is happy, one default will be diversified by other good qualities and mortgages, right? This is risk diversification of MBS. However, during the bad times, when every mortgage has the risk of default, one default is pulling the trigger of contagion, right? Okay, so this package becomes highly risky. You never know which mortgage will default, okay? So investors who are holding this MBS decided to fire sale this MBS, okay? Because they don't know whether their MBS contains some mortgages that have defaulted. So just imagine everybody is selling MBS in the financial market. Then the price for MBS will drop significantly, right? So this is like fire sale of an asset. When the price of this MBS decreased significantly, these financial investors suffered significant loss, okay? For example, Lehman Brothers. They held a lot of MBS and they suffered significant loss because of the significant drop of MBS price, okay? They suffer significant loss, so to help them to get more liquidities, okay, on one hand, they were selling the asset, they're selling the MBS. On the other hand, they try to borrow money from other financial institutions or commercial banks. However, at that time, in 2007, nobody wants to lend money to others, okay, because it is the crisis period. During the crisis period, if you lend the money to your friends, you never know, maybe tomorrow he is bankrupted, right? He will be unable to repay you. So this is something called counterparty risk, okay? During the crisis time, the counterparty risk is very high. You don't want to lend money to your friends because it's very likely that the next day he will be bankrupted and he will be unable to repay you. So this red chart here shows the interbank interest rate. Okay, the interest rate a bank pays to another commercial bank. Okay, it's the rate of borrowing between banks, among banks. Okay, and we see that during the crisis period, it surges up significantly, right? This shows that commercial banks didn't want to lend to others. If you really want to borrow money from me, you need to pay me very high risk premium, okay? So Lehman Brothers couldn't borrow any money from others. And finally, it went bankruptcy. One of the largest financial institutions in the US, game over, right? And then this triggered panics. And then we have financial crisis. And then it's the story where the Federal Reserve of the United States, the central bank of US, yeah, started to bail out the market. So this is what happened for those periods. Now the question is, who should be responsible for this? Who should take the blame? Yeah? We need to find a reason for that. This is what this paper trying to find out, okay? How does this paper study this question? Well, there are debates, of course, about this issue. I mean, even after 13 years to today, it's still debated among economists. Yeah? Someone said we should blame the commercial banks. Commercial banks lack self-discipline. They lend to households crazily, right? You should require 30% down payment, or learn from China, 70% of down payment, right? Okay, if you want to buy a second house, we need 70%, okay? It's not risky at all. So commercial banks should take the blame. Or someone said, Wall Street was too greedy, okay? They purchased the NBS, okay? They persuaded people to buy a house, okay? The greedy Wall Street should take the blame. Indeed, this theory became very popular in the United States, and we have a very, very famous parade. It's called Occupy Wall Street, right? Maybe you haven't heard of this, but many United States households, okay, they decide to occupy the Wall Street to ask the Wall Street to pay for their loss. Yeah? So people were angry about these financial institutions. They should take the blame. They were greedy. They cheated us. Okay? And they also blame the rating agencies. Okay? A lot of rating agencies label those MBS, which are junk, but they label them AAA, AAA plus, right? Okay? Those rating agencies were blind. Okay? They were BBB plus, but you label them AAA plus. Yeah? Why were rating agencies blind? Rating agencies were not blind. Because at that time, the house price is increasing, right? MBS is a good asset, okay? It's not because rating agency is blind. Yeah? Anyway, there are a lot of arguments. So this paper tries to answer that. So now it's something that we don't understand, yeah? The paper developed a dynamic stochastic general equilibrium model. In short, it has a very famous name, DSGE models in macroeconomics, okay? Dynamic stochastic general equilibrium model. So what does it mean? It's a general equilibrium model, meaning that it tries to model this economy as a whole. It tries to model every participant in these economies, yeah? All of them, all of their behaviors are modeled. Okay, for example, in this economy, we have households. They are working, they are consuming, they decide to buy a house or sell a house or rent a house, yeah? And there are banks, they are lending, and their lending standard depends on income level and so on, yeah? And we have firms who hire households to produce some consumption goods, yeah? And we have government, okay, they levy tax, and they levy social securities and so on. So all these participants in these economies are modeled. Then this is called a general equilibrium. And it is called stochastic because it studies when there are some random shocks that hit this economy, what will happen to some variables in this economy. Okay, so it's stochastic dynamic general equilibrium. In short, finally we will get a system of difference equations. Okay? How many of you have taken my quantitative methods 2A? Can you raise up your hand? Not too many, okay? So for those who have taken the quantitative methods 2A, you should be familiar with difference equation, right? Okay. For those who haven't learned this, you will be, okay? You will learn what difference equations are, okay? Dynamic model. Okay. Anyway, then this paper studied 3 possible shocks that hit the economy and studied their effect on the house price. The 3 possible shocks they studied are household income suddenly increases. Okay? For example, there is some technology productivity increase. Okay, so all the households' income level increase significantly or exogenously. Yeah? So it's one type of shock. A second type of shock is suppose the bank's lending standard suddenly relax. Okay, so suppose banks suddenly become crazy and they decide to reduce the initial down payment to 0%. Okay, this is another source of shock. And a third source of shock is household expectation about the house price suddenly change. Okay? For example, originally all households believed that the house price will go this way, and all in a sudden, out of nowhere, all households believe that the house price will go in this way. Okay, so it's a sudden change of household expectations. And then this paper studies what effect will we have on the house price. And here is his findings. His model, of course, after carefully studied and calibrated with the real data, found out that the effect of income change and lending standard change has barely no impact on the house price. You see, they are basically horizontal, right? The expectation, by contrast, can basically explain all of this house price change. Okay? So conclusion, we have this house price bubble because households' expectation changes. Who should take the blame? According to this study, households should take the blame. It's your fault. You wrongly expect that the house price will increase. So you buy more houses and you pull up the house prices. It's your fault, okay? It's not others' fault. Well, intuitively, how can we understand their result? Probably they made some sense. For example, just imagine whether you want to buy a house or not. Suppose your income increases. Will this significantly affect your decision of buying a house? Probably not, right? If my income increases, I will increase consumptions or savings or investment in many areas. Why should I, or why do I need to purchase a house so badly, right? So a change in income level has limited impact. How about the lending standard? Suppose in China, just imagine, okay? Nowadays, to purchase the first house, we need to pay 30% down payment, right? Now suppose the government suddenly declares that the initial down payment is reduced to 20%. This is good news for us, right? We need to pay less as the initial down payment. But will this policy significantly increase our incentive to purchase a house? Probably yes, but maybe not very significant, right? Okay? How about the expectation? If everybody expects that the house price will increase, then I don't care about the initial down payment. I don't care about the cost of mortgages, right? I will buy the house because I expect that the house price will increase. I will buy the house and benefit from the capital gains, okay? In Chinese, we have a saying, 买房子买涨不买跌, right? Okay, we always buy a house when the price is climbing, okay? So this is the impact of expectations. So it seems that this model's prediction do make some sense, okay? So are you convinced by this model, by this story? How many of you agree with these findings? Raise your hand. Nobody. Or it's because you didn't understand it at all. I don't agree with it, okay? I'm not a guy who were easily persuaded. You know? This paper seems to forget one thing. Why did everybody's expectation about the house price suddenly change in 2001, right? His argument is that it's because people's expectation changed in 2001 that is responsible for the house price bubble. But he didn't tell us why everybody's expectation changed in 2001. Is it because everybody suddenly became crazy in 2001? Maybe this is something related with animal spirit, okay? Have you heard of animal spirit? Animal spirit is a terminology by John Maynard Keynes, okay? Keynes. He said, we are all animals, okay? Basically, we are not rational. One day we are very optimistic about something. The other day we become pessimistic, okay? We have emotions, okay? We make decisions sometimes in the wrong way because we have animal spirit, okay? Like this bear, right? Okay? So it is just like what Keynes said. It's because everybody has animal spirit. We are irrational. So we need a rational government to make a good policy, right? It's because everybody have animal spirit. It's because and everybody suddenly become pessimistic or suddenly become optimistic that we have economic fluctuations. So we need government policies to stabilize economic fluctuations, right? This is the whole central idea about the Keynes economics, yeah? The Keynes school. So we don't judge whether animal spirit is true or not. Probably, indeed, everyone has some animal spirit, right? Okay? Suddenly we are happy and suddenly we are sad, okay? It's probably okay. But if for all the US citizens in 2001, same time, same place, they have the same animal spirit and they believe that the house price will increase, this is not very convincing, right? Okay? So we cannot say animal spirit. Then others argue that maybe the household's expectation changed because of the Huyo by Wall Street. Yeah? They read newspapers, they read financial report. Those greedy Wall Street investors, they persuade those households to buy a house. They persuade them that the house price will increase. Wall Street was greedy, so they should be responsible for that. Of course, Wall Street is greedy. They have always been greedy, right? It's their priority objective to make money, okay? But Wall Street is greedy, then they should Huyo those households always, right? Why do they wait in 2001 to Huyo others? Huh? In fact, the NBS, this financial innovation, is not new. It has already existed in US in 1970s, okay? If this product can be used to Huyo people to make money for Wall Street, then Wall Street should have done this much earlier, right? You said Wall Street is greedy, I agree. Yeah? But for a greedy Wall Street, then they should have done this much earlier, okay? So it seems that this is not logically self-constrained, right? Then, if we want to explain why people's expectations suddenly change in 2001, maybe there should be some other things that happened in that year, okay? That changed everybody's expectation. That changed the Wall Street. That changed the rating agencies, okay? What is that thing? Monetary policy. Monetary policy, okay? So let me briefly review what happened about the monetary policy, yeah? In 2001, in United States, a minor financial correction happened. It's called the dot-com bubble. bursted in 2001. Okay? When the dot-com bubble bursted, there is some medium-level financial turmoil. So in 2001, originally, the Fed's monetary policy, the interest rate was about 5%. So when the dot-com bubble bursted, the Federal Reserve decided to cut the interest rate. Okay? And then in the same year, 2001, on September 11th, we had the terrorist attack, right? 9/11. The terrorist attack happened in New York, Manhattan. A lot of financial institutions suffered significantly. And at that time, the Federal Reserve didn't know how large the loss is. So what's their response is they decide to cut the interest rate further to save the economy. And then we can see that the interest rate is cut to 1% with extremely low interest rate. And this low interest rate have been kept for more than 2 years. Okay? When interest rate is low, the borrowing cost becomes lower. Yeah? So people will start to buy a house, borrow the mortgages, and so on. More importantly, because the central bank increased the money supply significantly, at that time, commercial banks, Wall Street investors, they had a lot of liquidities, a lot of money, okay? Because money is so cheap at that time. So they tried very hard to figure out how to generate some return of those money, right? Okay? At that time, I have some friends working in the Wall Street, so they told me what was happening at that time. They work in the Wall Street, and everybody's calling, okay, do you have some financial products that generate a higher yield? Yeah? I have a lot of money, I want to invest, yeah? Okay? So this is called search for yield, right? Financial investors have the incentive to search for yield. And finally, they realize that, okay, MBS is a good product. So that's why they invested a lot. Okay? All of this come from the easy monetary policy. And then what happened in 2006, 2007, why the bubble bursted? We see that in 2005, the Federal Reserve realized that, oh, the housing bubble was already very large, right? It's very dangerous. So the Fed decided to raise up the interest rate. But the speed is too fast, okay? They raised the interest rate significantly within a year, from 1% to 5%. What is the meaning of that? We can do a math, okay? Let me ask you, take a guess. If the interest rate on the mortgage increased by 1%, how many percent will your monthly repayment to the mortgage increase? How many percent? Take a guess. If the interest rate increases by 1%, okay? Nowadays, we have some calculators called mortgage repayment calculators, right? You can do this later or now, yeah? Suppose we borrow 1 million, 30 years of repayment, okay? If the interest rate is 4%, our monthly repayment was around something, right? And if the interest rate increased to 5%, our monthly repayment will be higher. And the increase of the monthly repayment is about 12%. Significant increase, right? So if the interest rate increased from 1% to 5%, imagine how significant increase of monthly repayment will we have. Now, do you still remember in the US, there are a lot of borrowers that paid 0 down payment. And they don't need to pay their mortgages for the first 6 months. If the monthly repayment increased so significantly, what will they do? Default, right? I didn't pay any cost. I didn't pay any down payment. There's no cost if I default. That's where we have a huge wave of default. And then that is what happened. later. Financial crisis. Of course, the Federal Reserve didn't admit this. Yeah, they don't admit that, okay, it's their fault. Okay? Instead, after the financial crisis, the Federal Reserve immediately lowered the interest rate, as you can see. They immediately lowered the interest rate to almost 0%, right? To bail out the financial market. And at this time, the interest rate was kept at 0.25% for more than 10 years, right? More than 10 years. It's even longer to save this financial market. And of course, with this easy monetary policy, the stock market in US have seen a great bull market, right? The Nasdaq index and the Dow Jones market stock index have surpassed the pre-crisis level far, far away. Yeah? And the house price in US also increased significantly. Now the price is much higher than the pre-crisis level. Yeah? So Federal Reserve issued zero interest rate. And at that time, when the financial crisis just happened, zero interest rate is not enough. Okay? Because even though the interest rate is zero, remember that nobody wants to lend money to others, right? Because we don't know the risk. Okay? So zero interest is not helpful because we have risk premium. So what Federal Reserve did next is quantitative easing, QE. Maybe you don't know the meaning of quantitative easing. It means that drop the money from a helicopter. Yeah? Drop the money from the helicopter. Everybody come to pick up the money, right? This is called QE. Okay? So with QE, it turns out that this policy is still not enough to bail out those Wall Street investors. Okay? So what the Fed did next is called toxic asset purchase. Okay? For example, this financial institution is in financial distress. Okay? Nobody wants to lend money to him. What Fed did is the Fed directly acquired this firm's asset. Okay? It's like merger and acquisitions. Okay? So this is how the Fed bailed out the financial institutions. And this already break the tradition of a central bank. Yeah? Central bank traditionally are not allowed to purchase asset directly. Yeah? Because the money they printed is the liability of the central bank. You cannot use the money you printed to acquire assets directly. Yeah? Anyway, to save the market, to bail out the Wall Street and New York's financial center, the Fed did basically everything. And then finally, the stock market went back to normal, the house market went back to normal, and people were celebrating, thank you very much, Federal Reserve. Yeah? But it's like a fireman who saved the fire. Okay? But we don't forget that probably this fire was initiated by this fireman itself, right? Okay? Anyway, this is just academic opinion, okay? It's not, I didn't mean that what I said here about the monetary policy is absolutely correct. It's still under debate, it's academic debate, okay? So if you are interested, maybe you can try to find other evidences to support your argument, okay? But for this kind of debate, in economics, we do have a famous debate. It's called "This Time is Different" versus "Money is the root of all evils," right? Whenever we have a financial crisis, economists and many investors, they choose to believe that this time is different, okay? For example, 2008 financial crisis is because of house price. 2001 financial crisis is because of the dot-com high technology firms. 1997 financial crisis is because of fixed exchange rate, the Asian financial crisis. Yeah? 1990 financial crisis in Japan was because of Japan's malinvestment in housing industry and monetary policy and so on. So every time they have explanation for different financial crises. So they call it, they said this time is different. And there's another opinion that said all the financial crises are caused by wrong monetary policy. money is the root of all evils, okay? And a representative of this view is John Tyler, okay? A monetary economist who is very famous for his Tyler rule. Yeah? He believed that the central bank should conduct the monetary policy according to the Tyler rule, okay? He is opposed to discretionary monetary policy. So as you can see from this paper, we see that this paper investigated a very interesting question, right? But before we rush to their conclusion and we buy their theory, probably there's still room for us to ask further questions, right? At least we can critically think about this kind of questions, okay? So this is how I say we should learn economics critically, yeah? So learn economics happily and critically. This is my initial intention, okay? So I'm trying to sharing more articles in those columns, and hopefully you will feel interested, and then we can discuss more together. And I sincerely hope that someday later, some of us will become leading economists, proposing models to fool others, okay? That is all for today's lecture. Thank you very much.